Fundamental analysis represents the study of financial news through the release of data on macroeconomic events, statistical reports, social factors, economic indicators, and political statements. In fundamental analysis, economic and financial data are analyzed to see what effect they can have on interest rates. Interest rates are one of the main factors that cause the movement of exchange rates for a given asset. Fundamental analysis consists in analyzing the actual result with the forecast to understand future price direction. Economic data is released every week and can greatly affect the market, making it volatile and risky at the same time. It is important to always stay up to date on fundamental news, even if your strategy is mainly based on technical analysis. Having a balanced understanding of fundamental and technical factors will help you make the best decisions for your investments, and will help you understand the potential price targets, taking advantage of opportunities that arise. Traders who rely solely on fundamental analysis are called fundamental traders. These traders have long-term structured targets and use a strategy known as position trading. They open positions based solely on fundamental analysis, and keep them open for months or even years. Some data affects exchange rates immediately, while other data might have a slower impact, adjusting the direction over the long term. In some situations it may be better to avoid entering the market, especially when you have a high-impact set of news that will be released at the same time. Negative news have a greater impact than positive news. This is an advanced aspect due to the modern behavior of financial markets. Before the release of a financial news, there is a phase of stagnation, or a phase of low volatility, followed by a phase of greater volatility after the release of the economic data. The economic calendar is a kind of agenda that allows you to view past and future economic news, as well as their date and time of publication. The economic calendar lists all the important events that have occurred or that will happen in a short period of time. We must learn to interpret and study the economic calendar, as at certain times the market will present strong volatility peaks, and we must understand when to open a position, and when it's better to avoid entering a trade. The stock market is unpredictable, unlike the Forex market, because it doesn't have an economic calendar. In the Forex market there are programmed news that allow us to know when the market could be behaving abnormally, and therefore help us prepare ourselves accordingly. To keep track of the economic calendar, we recommend using Forex Factory or investing. On Forex Factory you will find 3 different flags that will be placed by the side of the currency. The 3 flag colors are yellow, orange and red. Yellow flags have little impact on the market, and usually create movements of 10 to 15 pips. Orange flags have a medium impact on the market, and usually create movements of 20 to 30 pips. Red flags have a strong market impact, and usually create movements of 50 pips or more. The impact also depends on the type of news that is released. As you may see on the screen, on the left you have the date and the exact time of the news release, as well as the currency and its impact. By clicking on details, you will have more information about the specific news. On the right-hand side you can find the previous data, and the forecast of the current news. What really matters when analyzing fundamental data is to see if the actual result is bigger or smaller than the forecast. If the actual result is bigger than the forecast, then it will be represented in green, meaning that it is good for the currency. If the actual result is smaller than the forecast, then it will be represented in red, meaning that it is bad for the currency. If the actual result is the same as the forecast, then it will be represented in black, meaning that the result is neutral for the currency. Investing is very similar to Forex Factory. Instead of having the 3 colored flags, it shows 1 star that is equivalent to the yellow flag, 2 stars that is equivalent to the orange flag, and 3 stars that is equivalent to the red flag, for high-impact news releases. Investing is great for international traders because it offers data in so many languages. Forex Factory only provides data through English language. Forex Factory is more simplistic while investing is more detailed. Opening a trade as soon as a high-impact news is released is too risky, because spreads increase significantly, and banks can manipulate the market. It is always better to wait 30 to 60 minutes before opening a position. When using these websites to monitor the economic calendar, we suggest to avoid reading all types of forums, because they will only confuse you. Use these websites only to monitor data, and only rely on yourself and your analysis when entering a trade. People that spend their time commenting on these websites are certainly not successful traders to follow. The non-farm payroll is also known as the NFP report, and it is a key indicator for the U.S. economy. Non-farm payroll releases a simple data: has the United States increased or decreased its total number of jobs? This data represents the total number of paid U.S. workers of any business, excluding farm employees, private household employees, government employees, and employees of nonprofit organizations. The NFP report is used to assist government policymakers to determine the current state of the economy and predict future levels of economic activity. The number of jobs added or lost over a certain period of time is a strong guide to future interest rate movements. The non-farm payroll is released the first Friday of the month. The released report provides the data of the net change of U.S. jobs for the previous month. So if the report is released on the first Friday of October, this means that the data is referred to the month of September. NFP is the most observed fundamental news regarding high volatility impact, together with central bank events or decisions involving interest rates. Straight after the data has been released, there will be sudden spikes in price across all dollar pairs. The NFP report is so important because the United States have the largest economy in the world, so the health of the US dollar affects the health of other currencies in the world. If wage earners are growing less than expected, it is certainly not good for the US economy. Instead, if wage earners are growing more than expected, it is certainly good for the US economy. It is important to monitor the markets closely when the data is being released, and more importantly, it is vital to avoid trading during the hours in which the data is going public. Increasing your risk of being caught out with slippage is never worth chasing for an additional few pips that you can easily make on any other trading day. Instant gratification is a downfall when it comes to trading. Stick to simplicity, stick to your strategy, and try your best to avoid highly volatile trading days such as NFP Fridays. Just after the release of the NFP, spreads increase significantly, because brokers know that there are many people interested in trading for the release of this data. Many analysts, traders, funds, and speculators try to anticipate the NFP number and the future price direction. With so many different parties watering this report, and interpreting it even when the number comes in line with estimates, NFP data will tend to cause a major disruption to the markets temporarily. Unexpected volatility in the markets can often invalidate any logical technical chart pattern or setup. It is suggested to stay away from non-farm payroll and start trading the following week, once there is a stronger sense of direction. The gross domestic product is an economic indicator, which indicates the total value of goods and services produced in a country, and analyzes the health and economic growth of a particular country. In 1934, the modern version of the GDP was introduced by Simon Kuznets, who won the Nobel Prize in Economics. In 1944, at the Bretton Woods Conference, the GDP became the main method of measuring the economy of a particular country. The GDP reports have a strong influence on the market sentiment, and often shake the market with high volatility. This volatility can last for hours, especially when results deviate significantly from the analysts' forecasts. The speed of volatility created after the release of the GDP can create many high-risk and high-reward trading opportunities. GDP is considered an important part of fundamental analysis, and in the economic calendars it is marked as a high-impact event. Professional traders carefully analyze the GDP release to decide whether to open a new position or whether to support the active ones. The GDP is based on 4 key elements: the consumption of private and public goods, private and public investments, government expenses, and foreign trade. The general formula to calculate the gross domestic product is equivalent to the total consumption of personal goods, plus the total investments, plus the total government expenditures, plus the total exports, minus the total imports. The GDP figure may not always be reflected by the market. Often GDP data is already partially integrated into the market, meaning the market may not react as expected once the data is released. GDP is a lagging indicator, which means that it is only calculated at the end of the concentration period. Therefore, it does not take into account real-time economic change. However, this all depends on the expectations of the analysts. If the figure turns out to be worse than expected, it means that the economy is shrinking, and a recession could begin. The currency of the economy will have a bearish movement. If the figure is better than expected, it means that the economy is expanding and investors are gaining confidence. The currency of the economy will have a bullish movement. If the data is the same, or differs slightly from the expectation, bilateral movements may occur, without excessive volatility. If the periodic change in GDP is negative, for 2 consecutive periods, the alarm bell could start to sound, as it would be considered a signal of economic recession. GDP is calculated periodically, on a quarterly or annual basis, to measure how the economic value of local production activities change over time. GDP for the dollar, pound, and Canadian dollar has a monthly, quarterly, and annual release date. GDP for the euro, the yen, the Australian dollar, and the New Zealand dollar has a quarterly and annual release date.